That playing in the background is Money by Pink Floyd, and that's what I want to talk about today is how money is made in the payment ecosystem. I'm Rich Bialek, and welcome to the Bialek Group Report. Let me put Pink Floyd aside for the moment, and we'll talk more about money. What I want to do is take you through the value chain in payments and look at the stakeholders, their role, and what they contribute to the creation of value in that value chain. Let's start with banks. Banks hold the licenses that allow them, give them authority through central banks, other regulators, payment networks to hold funds. They also are a source of customers in many cases. Next, we have payment networks. It could be mobile network operators like MTN, or it could be the payment networks, Visa, MasterCard. They have a network model connecting tens of millions of merchants to end card holders, account holders. That's a key part of their value creation. Their role is to authenticate, authorize, clear, and settle transactions. Then we have processors. In some cases, they're independent of the other stakeholders. Other times, they're entities or platforms that are owned by a bank or other players. But in this case, we're looking at a processor that's a standalone. They are a connector. They provide the necessary operations to help move funds from point A to point B in a safe and secure manner. And then last, we have program managers, fintechs. Fintechs are where the use cases are put together and delivered to the end consumer. They help deliver, find, grow, and acquire customers, and really are the keepers of that value proposition. You put it all together, how do you make money? Well, you make money by moving money and exchanging money. And if you look at the role that each of the players play in this ecosystem, like offer up perhaps an estimate of what their share is. When you look at banks, they really are leveraging their license and to some degree their customer base. They may gain 10 to 20% of the value. The networks, probably around 10%. They're hoping for volumes. They want to see more transactions crossing back and forth. That leaves about 70% to be split between processors and the fintechs. And it really depends a lot on who's adding what specific value. If there's 70% to be shared, most cases the fintech gets a little bit more, say 30 to 40. Not a hard number, but just to give you a sense of where value is created. Now I want you to think about what do you do, understanding your role. You're successful at that. Say you're a fintech. What do you do next? Well, I think you've got a couple of options. Do you try to integrate backward into that value chain? Do you want to do processing? Do you want to develop your own network? Do you want to be a bank? All valuable, but think carefully about that, because although you may grab some margin, you also have a big commitment in terms of addressing infrastructure, technology, and regulatory review. Other options I think may be more relevant to consider in that pursuit of money is product line expansion. Do you go beyond a certain type of payment? Maybe you get into lending, maybe you get into other services. And then I think you also need to look at geography, other markets, some other demographic markets, perhaps out of a B2B to B2C, or geography, other parts of Africa or outside of Africa. So hope that helped a bit. Just wanted to provide that overview of how value and money is created in the payments ecosystem. I'm going to go back, listen to a little more Pink Floyd, I think Dark Side of the Moon. And I want to thank you for joining the Bialek Group today. If you enjoyed what you've heard, please like, share, follow, and I hope to see you again soon. Thank you.